and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, we're back with Tim Sustak, Chief Treasury Officer, and Scott Wood, Chief Investment Officer with Vizo Financial. Scott, let's get started today by talking about the 10-year Treasury. Do you anticipate the 10-year going up over the next 6 months?
Good morning, Jamie. That's a good question. So we have seen a nice rise, I guess, depending on where you're coming from. We've seen a nice increase in the 10-year Treasury here over the last 2 or 3 months. So for investors, a good thing. They've been able to get higher yields further out in the curve. So what we saw last year, is the thoughts on the Fed were changing as the 10-year got up and it touched 5%. We were right around 5% on the 10-year. And then we got to the point where coming into this year, the markets, remember, they thought the Fed was going to cut 6 or 7 times. The 10-year Treasury started to come down and we went below 4% into that 380, low 380 range. Well, since then, we've kind of seen a sideways and upward moving Treasury rate. So now we're at the 440 range. 448, I think, is where we're at today on the 10-year, which is a little bit lower than it was a couple of days ago, but we're in that 440, 450 range. Mm-hmm. And we've kind of been trending sideways here a little bit in the last couple of weeks, but the trend has been higher. There's certainly more room to go higher. We could certainly see the 10-year go a little bit, push a little bit higher. And a lot of this is going to be anchored, determined by where the expectations are for inflation. So today we had a little bit tamer inflation reading, 10 years down a little bit, expectations of the Fed cutting, kind of normalizing the curve. Those things are all going to impact it. So there's certainly room for a little bit more growth in the 10-year. But it feels to me like we're kind of at the point where there's not a whole lot much further to go higher, unless there's a big surprise on an inflation reading. And I don't think we anticipate that. Tim may have a different view than I do on that, but I don't anticipate anything crazy coming out on inflation anytime soon. So more than likely, we're close to the peak on the 10-year for this year. Okay, is what I think.
All right. So, Tim, what economic indicators is the Fed going to be looking at right now in preparation for the next meeting?
Well, good question. I think, like Chair Powell says all the time, the totality of the data, right? So they're looking at all of it. But I think there's certainly some important releases between now and then. This morning we got updated PCE data. On June 4th, we'll get another JOLTS job openings and labor turnover report. On the 7th, we'll get the employment situation again, which is very important. And then on the 12th, the day that they make their announcement, there'll be a CPI report again. So, some really good employment and inflation reports before they make their announcement on the 12th. Overall, they want to make sure that they're still marching, slow as it may be, to their inflation goal while not harming the jobs picture. And, you look at it, the PCE came in today, nothing exciting, kind of like Scott said, right? No big surprises, kind of right around expectations. The headline number was at, up 0.3% for the month, 2.7 for the year. Ex-food and energy, 0.2 and 2.8. So, about what was expected. So the market's probably kind of shrugged that off. People will take what they want from it. Those that are looking for, thinking inflation is on the decline will have a little bit to say. And, others will be able to say, well, hey, not much happening. And, on the job front, unemployment rate has been around 3.7 to 3.9% this year. Payrolls, first quarter, pretty good job creation, mid 200s to a little over 3. April was down a bit to 175. So we'll certainly want to see if that's the start of some sort of trend, whether that's just a little bit of bump. But, still 175 certainly isn't horrible. But, I think that certainly the jobs and inflation numbers will be what they're keying on before the meeting. And, we got we got some inflation rings that, the markets thought were hot here in the beginning of the year. This, maybe is the start of at least not hotter than, than expected. But we'll see. I think we're kind of, like Scott said, kind of no surprise and just kind of stuck right now.
All right. So Scott, based on all this data, what are you predicting for the next meeting? Are we looking at a hold, or what do you anticipate?
Yeah, definitely a hold. The Fed will, as far as rates go, they won't do anything at this meeting. As Tim said, the data has been relatively stable. While unemployment rate has ticked up slightly over the last couple of months, it's been small. Inflation continues to, go sideways or come down slightly. It's really rounding errors at this point. So there's been minor moves in, directions that might move the Fed at some point. But for this meeting, there's 0% odds that the Fed's going to do anything with rates. Certainly, they could change their outlook, and we'll get a new dots plot at this meeting. Okay. We'll get their new economic outlook going forward. So we could see a tweak there. I would, if you remember at the 2 meetings ago when they met, they basically said they were still in the 3 rate cuts this year. So they don't have a lot more meetings to cut rates. So that very likely could lead to a change in their outlook, but certainly no moves at this meeting. It's really pay attention to what they say in Powell's press conference and see, to their new dots plot and those type of things to just get a gauge for what's going to happen going forward.
Okay. All right. Well, both of you have already kind of touched on inflation. So Tim, which way do you anticipate inflation going over the next few months? Are we looking at a resurgence, or has it subsided?
Well, I certainly agree with what Scott said earlier. I don't expect any big surprises either. I think we're going to continue to see kind of what we've been seeing, which is, kind of this really, really slow slog. Maybe you want to say it's a bit of a downward trend. I mean, certainly we're down from the highs, but like we said, right now it's, like Scott said, it's kind of rounding errors, right, one way or the other. And I kind of expect that to continue. I think we'll see a slow, really slow slide down. I mean, there's debate on whether we think rates are restrictive. Are they quite restrictive enough? There's some talk about, is a neutral rate now a bit higher than it was before? And I think we won't know that till we see more data. As Scott said, certainly a month or so here doesn't make a trend. I mean, the Fed is going to want to see, I think, at least a quarter's worth or more data before they're willing to say that there's a really good trend, or they have a comfort level that inflation is dropping back. And right now, like I say, I agree with Scott. I kind of see it going sideways, and I don't think we're going to see any appreciable moves here in the next couple months where we would say, wow, it's really receded, or it's gone the other way. I just kind of expect this kind of slow slog that we've been seeing. So,
okay, all right. Well, Scott, at the beginning of the year, we were looking at or predicting multiple rate cuts. And then that number's decreased. And then the last time we met, you were still predicting a potential of 1 rate cut yet this year. Do you think that's still on the table?
Yeah, I think there's still a chance the Fed could cut late this year, in November, December. So will they cut this year? If they don't cut, I wouldn't be surprised at all. I mean, I would say my outlook today is 0 rate cuts to maybe 25 basis points, 1 rate cut as a possibility. And that's kind of what the markets are saying too. The markets are giving a rate cut, around 90% chance at the November meeting, which comes the day after the election, presidential election. And then they're giving over 100% chance of a December rate cut. I would say, but listen, based on what Tim was saying, which I agree with, as far as this really slow move forward, it's really hard to. The Fed could do a rate cut. They could justify it if they needed to at some point this year if inflation continues to slowly come down. But there's certainly an argument to be made that they should sit tight and do nothing. As Tim pointed out, there's been a lot of talk. Is this the right rate? Is this neutral? Is this actually slowing the economy? There's been some talk amongst some public comments by some Fed members that maybe this rate isn't restrictive enough where we're at today, meaning that they may have to raise rates. nil cash carry. Minneapolis Fed came out earlier this week saying that nobody's taking rate hikes off of the table. So there is the potential for rate hikes, very slim, right? So I would say the odds of a rate hike are pretty small, but certainly what that leads to me to think is the odds of a rate cut are also pretty tiny if there's still talk about a rate hike. So the data obviously will determine that, but the odds of no moves this year by the Fed are pretty high. I think there's a pretty good chance the Fed may do nothing.
All right. Well, Tim, every time we meet, I have to ask you about liquidity. So what is happening on the liquidity front? Are credit unions seeing tight liquidity?
Well, I think, there's still the haves and the have-nots, and you always have that to a certain degree. But, coming out of the liquidity crunch we've seen the past couple of years, I think some have righted the ship a little easier than others. But overall, I think we're in a much better position, sitting at the beginning of June this year than we were same time last year, certainly. And I think our credit unions generally feel that way as well. We just got done with our financial strategies workshops that we were out from March to May, I guess, and talking with credit unions. And I think the general consensus was, a lot of them felt like, this year was going to be a better liquidity year for them, or certainly not any worse than it's been, which is a good sign. And I would say, certainly our numbers here at the corporate, watching what members have been borrowing, watching where our deposits have been here, we're certainly overall, and like I say, there's going to be some outliers here and there, some that are still struggling, but overall, I think we're certainly in a better liquidity situation, as a credit union community than we were last year. Now, having said that, and this is a debate kind of we've been having internally. It just, where is this thing gonna land? And we're moving into the summer months. June is right around the corner, and summer is when we start to see credit unions shed deposits. So it'll be interesting to see where that goes this year and just how tight it gets, as we move into the tighter months there, certainly end of August into September, where things are at. So right now, I think things are good, but we can't fall asleep yet.
Okay.
So.
All right. Thank you. All right. So Scott, could you share a little bit about what you're seeing in auto and mortgage environment and how this impacts the credit unions?
Yeah, so I guess overall trends have been a little bit of a slowdown in both markets, or slower than expected. And with housing, obviously, we're getting into the housing season where people start to buy homes, to move for the summer months and things. So we're getting close to that. So it'll be interesting to see what the data looks like going into there. Part of the problem relates back to what we talked about with the 10-year Treasury, where it's bumped higher. Mm-hmm. The 10-year Treasury is directly correlated to the 30-year mortgage rates. So what's happened is the 10-year Treasury has climbed, so have 30-year mortgages, which is what that has done has made home purchasing less affordable, right? It's made it more expensive, so it makes it more challenging. And it makes it harder for people that have these lower mortgage rates, sub 3%, let's say, that a lot of people got during the COVID crisis, refinanced or purchased new homes at these low rates. It really takes away their incentive to move unless there's a compelling reason, a job change or something along those lines that would compel them to have to move. Otherwise, there's very little incentive to put your home on the market. So homes on the market, I think, it'll be interesting to see how it goes over the summer. In my neighborhood, there's a little cul-de-sac up the street, 3 houses, and there's probably 12 on that little cul-de-sac. 3 of the homes are for sale right now. 1 is actually sold, and 2 are still for sale. So I don't think it's a hating neighbor type of thing. I think it's just trying to take advantage of the situation. But in any event, we'll see what the number of houses are there. And then the other battle is fighting against that higher mortgage rates. And the same applies to auto on the auto side of things, right? Auto rates have maintained a pretty high level as interest rates have on the new and used market. We talked about this at some of our financial strategy workshops, as Tim talked about. Car and housing affordability have gotten really challenging. So a lot of people have payments of over $1,000 on new cars if they're buying a new vehicle, which is kind of crazy when you think about it. $1,000 a month car payment, but I think there's like 30 some odd percent of new auto loans are above $1,000. So there's a good amount of people that have these $1,000 loans. The other trend, so there's been a couple of trends on the auto side of things in the first quarter. Credit unions, their share of overall of the auto market, so this includes new and used loans, has shrunk. So it's been coming down this quarter. So they're now in third place. The captive finance companies and the banks are above them right now. The captive finance being the the auto dealers and things like that. So credit unions are in third place there. They've seen a drop in the first quarter, and also kind of credit unions bread and butter, the used auto segment. They had been in first place there for a little while. They had been leading the pack on used auto loans. Banks have now in the first quarter slightly overtook them. So banks now have are generating the largest share of used auto loans too. And another thing to consider too is the number of autos that are being leased has been increasing here recently. So these higher prices, higher rates have led more people to look to the leasing option, which lowers their payments a little bit. And I know not every credit union is in the leasing space. There are some that are in that space, but predominantly when you think of leases, you think of the captive finance companies are gathering, they're taking most of that business. They're the ones offering these lease deals, and it's easy to do that. So it's going to be a challenging environment this year on both fronts for credit unions, but certainly there's room for, they're still going growth. It's just going to be slower growth. And the competition has gotten more challenging, as well as the affordability are kind of some of the big things they're fighting against.
Yeah, I think I shared with you guys before that I had been holding on buying a car, and I was holding as long as I possibly could. But we recently did purchase a car, and when I see that payment around $800, I'm like, oh my gosh! I'm like, I can't believe it. My first mortgage was only $1,100, and now I'm paying a car payment at $800.
Yeah,
it's a little bit of shock as a consumer.
Yeah, it really is. You're talking about the housing payments versus the car payments, and it's really silly. When you look at those numbers, especially people that got homes at sub 3% or sub 5%, they may have a really nice house with a $2,000 or $2,500 a month payment, and they're paying $1,000 or more for a car on a monthly basis. Something that's going to depreciate. We know.
Yeah. Wow. So Tim, what else would you like to share with our credit union audience today regarding the current environment?
Jamie, I don't know if I have anything else for the current environment. I guess I would just say, talking about liquidity, we're moving into the time where we start to lean out. So please, just reach out to us, certainly watch liquidity. The earlier you can reach out to us, if you think you might have a liquidity shortfall, the easier it is for us to certainly help you. We're going to help you either way, if you come to us in the 11th hour or you come to us 3 months prior. But, we've got certainly more options today than we've, had in past years to help with liquidity. So, the earlier we know, the easier it is for us to help you. So, we stand ready. So please reach out if things get tight over the summer.
All right. Scott, any final thoughts for our listeners?
Yeah, I would just stress what we've been talking about for months now. Just continue to pay attention to the Fed. Yeah. Look at the incoming data. Tim talked earlier about some of the key components, the key indicators to keep an eye on. I would say keep an eye on those indicators and really listen to the Fed. Next Wednesday, we'll have an update from the Fed, so see what they have to say. Good chance that they're going to kind of update their thinking over the next few months. I think they should anyway. Whether they will, we'll see. But there's a good chance we could see a little bit of a tweak there. The other thing I would caution too is on the side of delinquencies. We certainly have been seeing an increase, and hearing this too from credit unions. But when you look at the national data, there's been an increase in delinquencies with auto loans. Mm-hmm. And with credit cards, as expected, right? We would expect those things to increase as the economy starts to show some signs of stress. And it seems like there's this kind of tale of two economies right now. There's a group of folks that are struggling and a group of people that are doing okay, but there's certainly a lot of people struggling. So keep an eye on your loan performance. I would say keep a close eye on that. Be prepared to maybe repo some vehicles, or have some credit. Some of your members maybe just turn in their keys. We've heard talk of that too, where credit unions have been members have been voluntarily turning their keys in because they just can't afford it. So they're trying to get in front of it. Some of those folks too. So those are some areas I would kind of focus on over the next few months.
Okay. Well, as always, thank you both so much for joining me today. It's always a pleasure having you on to talk about these things. So,
Thank you, Jamie.
Thanks, Jamie.
This episode of Financial Minds Meet the Experts is brought to you by Vizo Financial's ALM Model Validation Service. Accurately setting your models and testing them is essential for good asset liability management. The reports from testing your models can translate into confident business decisions to help grow your credit union. All these things make Vizo Financial's model validation service an invaluable tool for credit unions because it satisfies the regulatory requirements and strengthens reliance on ALM models for better balance sheet management. For more information about Vizo Financial's ALM model validation solutions, please reach out to our ALM team at almservices@vfccu.org. As always, thanks for listening and make it a great day.